This is a demonstration of the business analytics tool that we've been using to go through and do some analysing of some clients' financial statements just to see where they can improve their business, improve their cash flow and improve their value. So as you can see on this, we have revenue steadily increasing, gross margin steadily increasing, so that profit after tax steadily increasing, amortizations staying fairly stable, so it's depreciation of assets, interest paid is increasing, and the tax paid is increasing as you would expect given the profit increase. And also we have down here the distribution or the dividends, so that's effectively what's paid to the business owners, also increasing. Down in the balance sheet we have total assets, which is steadily increasing also, accounts receivable increasing, stock, inventory increasing, current assets are increasing, and our fixed assets have become steady, increased significantly in the short term. The liabilities are also increasing. The accounts payable, so who we owe money to, is increasing. And then we have our total liabilities, which is also, total current liabilities, which is also increasing. So there's a few things that we'll analyse out of this. As you can tell from this, the company is growing. Their revenue has increased significantly over that 4-year period to nearly double. Obviously their assets are increasing, their liabilities are increasing, so they're a rapidly growing business. This tool is going to give us the ability to see what will happen if we change certain things, to analyse where we're at, to see what issues there are in a growing business. Sometimes as businesses grow, we all think that that may always be really great, but some things within here may not be so great. So we're going to check out and see what the analytics says on this business. So now we're in the summary, which is taken from the financial statements that we just looked at. As you can see, revenue's good, cost of sales, we have a gross profit, then we have less our overhead costs, gives us an operating profit. Our revenue gets a green light, it's gone up this year. Our gross margin gets a green tick, it has increased, so the difference between what income we're getting for the sale of our products compared with what it costs to manufacture those products has increased. Interestingly, the operating profit has decreased, as in percentage to overall sales. So although the operating profit has increased, how much profit we're making compared with how much we sell has actually decreased. And then we have our net profit, which is also increased. Balance sheet, so this is our owner's equity. It is made up of all of our assets less our liabilities. This is an interesting one, our accounts receivable days. So when people owe us money, how quickly are they paying? Nearly 80 days. Inventory days, this is how long is our stock sitting on the floor for. Accounts payable days, so that's how quickly are we paying the people we owe money to. So our working capital days, effectively what this is a combination of these two minus this one. So what it really shows is how many days we have to fund the business for until the sales hit the bank account. And this is not a good number. Basically, it's showing that for 154 days, when we've made sales or when we've had to pay for things, sat there for 154 days until we've been able to get the money back for selling those products. And this is just related to our cash flow. So our current liabilities are highlighted on the top, and our non-current liabilities, or our non-current bank loans I should say, are along the bottom. So as you can see, what we were talking about here was having to fund for a period of time, buying stock and waiting for clients to pay. That is why this current loan is increasing, because it's taking longer and longer for us to get the money for what we've already paid for when we sell something. So that's why this is increased, and that's why our funding of this business is increasing over a period of time, and increasing quite significantly. So when we look at our story down the bottom, we have zero cash, which is obviously not good. We have current bank loans, which have increased, which is also not good. The non-current loans haven't, which is great. But our net cash flow is negative $193,000. So effectively, even though we're making greater profit, because it's taking longer and longer for us to get the money for the things we've already paid for, we have to pay for them using loans, so our cash flow is actually negative. And we'll just quickly look at chapter 1, which is all about profitability. Profitability in this example. So revenue, so that's increased, which is always nice. The gross margin has increased, which is good. Operating profit has increased, also good. Our retained profit is what we're keeping at the finish, is up, but not in a great deal compared with some of these other items. So $10,000 increase is not a lot when you've had an extra increase of $812,000 in sales. So as we look at here, profitability is going up, which is good. However, our operating profit is stagnant and actually decreasing in a percentage terms. And as a percentage of sales, our net profit has also been very steady. So what it's showing is, even though our revenue is increasing, our profit margins, our profit is not really increasing. So our revenue growth compared with our cost of goods sold is pretty flat. Our revenue growth compared with our overhead growth is not good at all. So as we're increasing sales, our overhead costs, our costs of producing those sales, has increased significantly, and that is true in each of the years. So as our sales are increasing, our expenses are actually increasing by more. That of course is as a percentage, and that is shown through here. We can have a quick look at increase in revenue, the movement in revenue growth, our gross margin percentage, overheads, as we said, increased. Overhead percentage as a percentage of sales has increased, which is not good. Our operating profit percentage as a margin of sales has decreased. Not a lot, so it's not a massive issue, that one. EBITDA, so this is earnings before interest and tax and depreciation and amortization. This is basically the number that is used to value the business. Usually we'll take a multiple of that number Usually it's somewhere between 3 and 5 times that number. The net profit percentage, our retained profit, and then interest cover. So interest clearly as a percentage of sales. Now this was an area of concern, which is the analysis of our working capital. Our accounts receivable, as we said, has gone up significantly. This is the people that owe us money, so it's taking longer for us to get the money out of those people, which could be our problem. Could be that we're not billing quick enough. We're not looking at getting deposits up front, things like that. Could be their problem, that they're having issues somewhere in the industry. There may be issues in getting the cash back. And as we sell more, we have more out available for people to be trying to pay us. But if they're not getting paid, then that could be an industry issue. Our inventory has increased. So we're producing more, but it's sitting in our stock for longer, whether that's in our warehouse or wherever it may be. Our stock on hand or our inventory on hand is increasing, which is not a good sign. Our accounts payable has increased, so the people we owe money to has increased. And then also our working capital has increased significantly, as we spoke about earlier. So we have to basically fund an extra $453,000 this year. So you would expect that our short-term loans would have went up by a similar amount, because somehow we're going to have to fund paying all of our bills when we're not getting the money quick enough. That's basically what this is showing. So our working capital trends, as we said, they're not great. Accounts payable, so that's people who we're paying money to, has not moved a lot. Our inventory days are going up significantly as our revenue grows, and so is our accounts receivable days. So we have a timeline to show this a little bit easier. So we have inventory arrives. We're paying people for that inventory. The inventory sold, and then we get the money in the bank. So as you can see, from the time that we purchase and have paid for this inventory, we're funding this many days, which is 154 days. The projected cash impact of that is negative $186,596. So it's obviously a significant amount. The working capital per $100. So $36 working capital. This is made up of inventory plus receivables less payables. So our investment in working capital is obviously going up. We're investing more into inventory and accounts receivable because it's taking longer to get that money back. And we have a gross margin versus working capital per $100. As you can see here, we're reasonably okay here in 2016. As we've grown, this has gotten out of shape. And lots of red dots down here to work through to try and change in this business. We look at the third page, our other capital. So our fixed assets have stayed the same. Other assets have increased slightly, liabilities increased slightly. Other capital hasn't moved. So our trends are fairly stable on this. Plenty of green ticks, a few small changes down the bottom here. Obviously our return on how much we're putting in is lower, which is not good. So the business owners are getting less back, basically because it's taking so long to get things done, to get the revenue back into the system. Funding, as you would expect, this is all increasing, which is not a good sign. Our total debt is increasing. Total equity, so how much money the owners are having to put into the business, is increasing. So our profit versus our cash flow. This is really quite interesting. As you would expect, our profit's going up, but the cash from the customers is actually going down. And that's because it's taking us too long to be able to get the money out of the people we're selling to. So we're actually having to fund this. So cost of goods sold, cash to suppliers, we're in the negative again. So we're actually paying people reasonably quickly, which you would expect, so that we can keep our business operating. However, the cash that's coming in is coming in quite slow. And it's basically meaning that we're going to have to fund all of this extra money, $453,000, which is a lot. Profit versus our cash flow. You would hope that as our profit goes up, that our cash flow is getting up somewhere near the profit. And to be honest, it's nowhere near on this. So it's not a great sign, because effectively it's costing us money because we're having to borrow to keep the business going. So as we're increasing our sales, growing our business, we're not actually becoming any more profitable, and we're not getting any more cash in our pockets. It's an interesting scenario, this one, to look at, because we often think as we are growing a business that the cash in our pockets is going to be greater. But depending on how we have to fund the business, it can actually go down. And in this situation, it's a perfect example of that, where the business hasn't been set up well enough in certain areas, so that even though the business is growing, it's not actually generating any more cash into the pockets of the business owners. Now this is a really cool tool. So this is the power of one, and what it looks at is if we change our prices by 1%, what happens? What is the impact on cash flow? What is the impact on profit? So as in this situation, if we had a 1% price increase, so on our sales we're going to add 1%, the impact on the profit is it will increase by 66,000. The impact on the cash flow is it will increase by 51,000. If we look at volume increase, because we're funding so much of our business via loans, actually increasing more sales has a negative impact on cash flow. So we're actually going to have less money in our pockets by increasing the volume that we sell by $4,855. It's really interesting, because you would expect that as you tried to sell more, you would actually end up with more in your pocket. But depending on how you're having to fund the running of the business, it may not be the case. So a reduction in cost of goods sold. So if we reduce our cost of goods sold by 1%, impact on profit is 46,000. Interestingly, the impact on cash flow, we actually get more cash in our pockets. So effectively what this means is if we have a more efficient process in how we're able to manufacture our products, then reducing those costs by 1% will actually increase our cash flow, which is a great thing. So that would be something that we would want to look at for this business. Let's just look at what are the current costs of goods sold, how can we increase or make a more efficient process that will reduce that. The reason that the cash flow has actually increases more than profit is because we don't have to have as much time funding those cost of goods, because we're not buying as much, or it's not sitting on the floor as long. Reduction in overheads, so for every dollar of overheads we can reduce, we get a dollar of cash in our pockets, which is great. and also reduction in accounts receivable days. Our accounts receivable days is really high at the moment, so we'd probably wanted to try and get that back to somewhere near 60 days, which it's nowhere near at the moment. And then reduction in inventory days. This is how long our inventory is sitting on the floor or in the storeroom. And then if we can increase the amount of time that we have to pay the people we owe money to, that will also increase the cash in our pockets. So it's an interesting scenario, this one. What we'll do, we'll just have a quick look at this, because I'll show you how this impacts on the value of the business. So we might say we want $5 million for this business. So we've got a targeted business value of $5 million. We have a current business value, $207,000. So we have a gap, $4,792,000. Power of one actually increases, if we did 1% on all of those things we looked at on the last page, actually increases our value of our business by $621,000 to get us to $828,000. It's amazing how much difference that can make to make the business worth 4 times as much just by having each of those 1% in. We'll go back now and just have a quick look at what we could do. So let's say we don't want to increase our volume. We're going to increase our prices by 2%. We'll just talk about our collection of cash. So at the moment, the amount of days that it was taking us to collect our cash was 80. Increase this by 20 days. Because it's actually a reduction, we have to increase here. So all this is effectively saying is what we're going to do is reduce the amount of time it takes for us to collect our money from 80 days to 60 days. So we'll put some processes in place to do that. As you can see, the difference in the cash in our bank is now $344,000. We also will reduce the amount of days that we have our inventory sitting on the floor. So we'll put some more efficient processes in place, and we'll reduce that amount of time by 2 weeks. And we'll leave that as nil. People will want to be paid at the same time. We can also look at reducing our overheads, which had increased significantly. So we might try and reduce our overheads by 5%. And then our cost of goods sold, we'll also try and reduce that by 5%. Now, as you can see, we're going to look to increase prices by 2%. We're going to reduce our cost of goods sold by 5% using processes to make things more efficient. We'll also do some processes to reduce our overheads by 5%. We're going to collect our cash 20 days faster, and we're going to have our stock sitting on the floor for 14 days less. Most of these things can be all fixed using an efficient process and system. The impact on our cash flow, nearly $1 million. When we look at the impact on our value, you can look at the significant difference that has made. So if this is our target, this is what we want to work towards over the next few years to get our business worth $5 million. You can see what having the impact on some of those things will have on our overall business value. So that was the analysis tool that we've been using. These are some of the things we can look at to see which areas of your business to focus on to really make a big difference to the overall profitability, the cash in your pocket, and at the end of the day, the value of your business.